Are treasuries still haven?
We think that they are. We think that bonds are showing probably their best value in the better part of the past 15 years. Right now, on inflation index securities, you can get a 2.5% real yield after inflation if you hold the bonds to maturity. And we think that because real yields are now positive, they're back up towards levels where we would see they're acting like a ballast against your equity market portfolios. We think that that correlation of returns between stocks and bonds starts to return back to some level of normalcy. This is the first time, really, since the global financial crisis that we can say bonds are material value for all types of investors.
So how do you really make that determination if it's not just about the fundamentals, but it's also about how much debt the U.S. sells? It's also about just where the buyers are going to come from. If the Bank Japan, it really abandons yield curve control. How do you know? How do you parse out the dynamics of that, the technicals versus the fundamentals?
Look, it's very difficult to call the top in any type of market. Ask the most astute of investors, and it's an extremely difficult proposition. But we take a look at long-term fundamentals, and we also have a lot of good models that tell us about the trend of underlying economic growth and where that should be relative to bonds. And we do think that inflation is likely to continue to fall over the course of the next few quarters. We think that the Fed is getting very close to being finished at this point. Even if they were to raise interest rates one more time, you are likely in the part of the cycle where the Fed is finished raising rates, and we have studied this many times, almost all times, when the Fed has finished raising interest rates, within 12 months, you have had a significant rally in bonds. Lastly, you're also at a very good point on the duration curve. Right now, if you were to own a 30-year treasury, and if yields were to go up by 50 basis points, you would only lose about 3%. If yields were to decline by 50 basis points, you have a gain of 13%. So there's this real magic to duration at this point, and it is very much in investors' favor.
Okay, so in an environment where bonds potentially rally, you're also in an environment where yields are positively correlated with stock prices. Can you make a case that bonds rally as stocks rally as well in 2024?
Oh, easily. I mean, look, you saw that type of sensitivity just over the course of September as well. Bond yields were starting to come down, and stocks were just rallying very hard at that point. I would say we're probably at the point of the cycle where stocks are in a bit more of a wait-and-see mode, right? Right now, you have sentiment that isn't necessarily in your favor to own stocks. The other issue, as well as breadth and technicals in the U.S. S&P 500 are not looking all that great at this point. You've got a number of stocks that are below their 200-day moving average, and you kind of need to see some of those things go back in a little bit of better favor to get that relationship where yields come down and stocks can indeed go up.